Imagine for a second just walking through downtown Houston right now. It is late April 2026.
Yeah, the weather's probably already getting a bit hot.
Right, exactly. So you're walking, you look up at these massive, beautiful glass towers just scraping the sky. And from the sidewalk, everything looks totally normal, like business as usual.
But it's really not. I mean, not at all.
No, it's not, because if you could magically see through the walls of those buildings, you'd realize that roughly 1 out of every 4 of those offices is sitting completely in the dark, empty, just gathering dust.
Which is a staggering visual when you really think about the sheer scale of the Houston skyline.
It's wild, and common sense tells you that if a city has this massive surplus of empty space, the landlords must be sweating, like they should be desperate, right? Slashing prices, offering these crazy deals just to get some actual foot traffic in the door.
Yeah, you would definitely think so. Basic supply and demand.
Exactly. But if you walk into a leasing office today, like right now, and ask to rent one of those premium spaces, they're going to hand you the most expensive price sheet in the city's history.
It completely defies financial gravity. I mean, you have record high vacancy living right alongside record high asking rents. It's wild.
It feels entirely broken. So that is our mission for today. Welcome to the deep dive. We are pulling the data from the newly released 2026 Q1 Houston Citywide Office Market Report by Lee and Associates.
And it is a fascinating read, honestly.
Oh, it really is. We're going to figure out how this paradox is actually functioning because it turns out the physical buildings haven't really changed, but the psychology of what a company is actually buying has radically shifted.
Yeah, the rules of real estate are just being rewritten in real time. Houston's skyline right now is functioning as this perfect, brutal laboratory for understanding post-pandemic corporate survival.
Let's get straight into the damage because the numbers here paint a really stark picture. We have this massive supply of empty space. According to the Q1 data, the direct vacancy rate in Houston just ticked up again to 22.8%, which is up from 22.5 at the end of last year.
Right. And honestly, that number is actually masking the true scope of the empty space because it doesn't account for the gray market.
The sublease space, right.
Okay.
Yeah, the report notes that when you factor in available sublets, which sit at a massive 5.4 million square feet across the city.
Which is a huge footprint, by the way.
Massive. So when you add that in, the total vacancy rate actually hits 24.1%. Almost a quarter of the entire market is just empty. And I want to pause on that gray market concept for a second because that has to be a vicious dynamic for a landlord.
Oh, it's a nightmare. It really is.
I mean, think about it. If I'm a tenant, right, and I signed a 10-year lease for 5 floors back in, say, 2019, and now, post-pandemic, I only need 2 floors. I'm putting those other 3 floors on the market at a heavy discount just to stop bleeding cash?
Yeah, you essentially become your own landlord's biggest competitor. I mean, the landlord is upstairs trying to lease out the empty floor on level 10 for full price, while you're down on level 8 offering a fully furnished space for, like, 70 cents on the dollar.
Wow. Yeah, that's brutal.
Cannibalizes the market from the inside. It really does.
So knowing that, my brain just completely short-circuits at this next statistic. Because despite all of this empty space, despite the sublease cannibalization you just mentioned, direct asking gross rents averaged $31.08 per square foot in the first quarter.
Yeah, 3108. It's incredible.
That's up from $30.07 back in 2024, and it's up 27.1% from 2010. Let me just use an analogy here, because if I run an airline and a quarter of the seats on my flight are empty, I run a flash sale. I slash prices to like $30 just to fill the plane because an empty seat generates zero revenue.
Right. That makes total logical sense for an airline.
So why on earth are landlords stubbornly holding prices above $31 while their buildings echo?
Well, so an airline seat is a pure commodity, right? It gets you from point A to point B. Whether you fly carrier X or carrier Y, the fundamental utility is exactly the same.
Sure, a seat is a seat.
Right. And commercial real estate used to operate somewhat like that. You were buying a roof, an HVAC system, and a place to put some desks. But an office lease in 2026 is a fundamentally different product.
How so?
Landlords with these premium buildings are defending their pricing because companies are no longer just buying a place to work. They are buying a talent retention strategy.
Oh, wow. They're buying a reason for people to actually leave their house.
Exactly that. The office now has to compete directly with the comfort of a living room couch, the like of a commute, the convenience of walking your dog at lunch.
Yeah, the dog walk is a huge perk.
Right. So that shift dictates everything in this report. You can't look at Houston as one unified market anymore. It is completely fractured into 2 separate realities operating side by side.
And the industry calls it the flight to quality, right? Because the data shows an extreme class divide here. We are talking about Class A space, which is the premium, highly amenitized tier, versus Class B space, which is your older, standard, maybe 1980s or 90s commodity office.
And the pricing gap between those two is just wild.
It really is. Class A asking rents just hit $36.48 per square foot, which is nearing prior cycle highs. Meanwhile, Class B slipped down to $22.53. That is almost a $14 chasm, like $13.95 exactly.
And keep in mind, that is just the citywide average.
Yeah.
When you zoom in on specific submarkets, the willingness of these companies to throw capital at premium locations is staggering.
I noticed that. The Katy Freeway East submarket stood out to me immediately. Class A rents there are hitting $59.88 per square foot.
Yeah, basically $60 a foot. It's unbelievable.
Almost $60. And companies are actively signing massive leases to secure those spots. The report highlighted Camden Property Trust taking, 104,000 square feet at Williams Tower, and the law firm Simpson Thacher leasing 99,000 square feet at 1,000 Main Street in the Central Business District.
Right, and those are enormous, decade-long commitments to top-tier trophy assets. It proved that tenants aren't necessarily downsizing to zero. When they move, they might take a little less space, but they are massively upgrading the quality of their footprint.
It's kind of like the shift we saw in the fitness industry. Think about someone who, cancels their basic $30 neighborhood gym membership.
Oh, yeah, the big box gyms.
Right, they don't stop working out.
Yeah.
Instead, they go pay triple for a luxury health club. The one with, eucalyptus towels, a juice bar, and a cold plunge pool.
The whole experience.
Exactly. Why? Because they only go 3 days a week now instead of 5, and they want those 3 days to feel like an exclusive experience to justify the drive.
That is a perfect analogy.
Yeah.
And the 1980s Class B building with the drop ceilings, the stained carpets, and the buzzing fluorescent lighting, that is that $30 neighborhood gym. It simply cannot win a war for talent today.
So if you are listening to this deep dive right now and your company just announced a move to a gorgeous state-of-the-art building with a barista on the ground floor, just know that it's a desperate retention tactic to keep you happy.
Yeah, they want you in the building.
But if your company is renewing a lease in a tired aging complex, they are likely playing a pure cost-saving game.
Which really brings us to the brutal reality for the landlords holding those aging complexes. If you own a Class B asset today, your pricing power is practically zero.
Because no one wants what you're selling.
Exactly. The market has dictated your choices. You can slash rents to the bone to compete on pure cost, hoping to attract, budget-conscious businesses. Or you could pour tens of millions of dollars into capital improvements.
Adding the lounges, the better air filtration, the fancy gym.
Right, to try and fake your way into Class A. Or your third option is you just give up on offices entirely and try to convert the building to residential or mixed use. Because just sitting there waiting for the market to magically return to your commodity space, that is financial suicide.
Wow. Hold on, let's follow the capitalist logic here for a second. Because if everyone from law firms to energy titans is practically throwing $60 a square foot at landlords for this premium Class A space, developers should be salivating.
Oh, they should be tripping over themselves.
Right. There should be cranes on every single corner in Houston right now, building luxury glass towers to capture that demand. So, are there?
Well, in a traditional boom and bust cycle, absolutely. That's how real estate usually operates. Demand spikes, developers overbuild, the market crashes and repeat. But the answer right now is a resounding no.
Which is so counterintuitive.
It is. But this is perhaps the single most important stabilizing mechanic in the entire Houston market right now.
Yeah, looking at the data, the construction pipeline in Q1 is basically a ghost town. There are only 483,654 square feet currently under construction in the entire city.
Which is nothing for a city the size of Houston.
Right. And to really feel how low that is, the report contrasts it with 2014. Back then, Houston had over 13 million square feet under construction. We went from 13 million down to less than 500,000.
It is a profound deceleration. And honestly, it is entirely necessary when you look at the demand environment.
Because demand is incredibly choppy right now. The net absorption in Q1, meaning the total space leased minus the space vacated, was actually negative 180,316 square feet.
Yeah, so we went backwards.
Following a decently strong 2025, we are suddenly back to emptying out more space than we are filling. So usually negative absorption combined with a dead construction pipeline means a city's economy is on life support. But reading between the lines here, you're saying this dead pipeline is actually a good thing.
Yes. It is functioning as a crucial safety valve. I mean, think about the mechanics of commercial development today. Developers are facing absolutely crippling construction costs. Materials and labor are sky high.
And money isn't cheap anymore.
Exactly. Financing costs are prohibitive. Regional banks are just not handing out $500 million loans for speculative glass towers on a whim anymore.
And just to clarify for everyone listening, speculative meaning build it and hope someone rents it.
Right. The field of dreams model.
Yeah.
That era is totally dead. The friction in the capital markets is so high right now that almost all of that 483,000 square feet currently being built is either built to suit for a specific corporate owner or it's heavily pre-leased.
So shovels literally don't hit the dirt unless a tenant is already legally locked in.
Exactly. Which is exactly what saves the market from itself.
Because if they built more, it would be a disaster.
It would prevent a slow recovery and turn it into a catastrophic collapse. I mean, if developers were pouring millions of new speculative square feet into a city that already has 24% of its offices sitting empty, property values would enter a complete death spiral.
That makes total sense.
By turning off the faucet of new supply, the market is giving this slow, painful recovery the runway it needs to slowly digest that 5.4 million square feet of sublease space. It effectively puts a floor under the market.
All right, so no new buildings are flooding the zone, but what happens to the existing buildings when they change hands? Because a 24% vacancy rate has to eventually crush property values, right? A skyscraper is only worth what someone will actually pay for it today.
And we are seeing that valuation reset play out in real time, and it is entirely reshaping the investor landscape.
The drop in sales price is just breathtaking. According to the report, office sale prices hit historical peaks back in 2017 and 2018 at well over $300 per square foot. In Q1 2026, the average sale price collapsed to just around $78 per square foot.
Let's really dig into what that actually means, because that $222 per square foot drop didn't just magically vanish into thin air. That represents a massive destruction of equity.
Real money lost.
Huge amounts of it. If you bought a tower for $300 million in 2018 and it's now worth $78 million, your equity is completely wiped out. The regional banks or the pension funds that finance that original loan are taking massive haircuts. It is a profound transfer of wealth.
But the wild thing to me is the market hasn't frozen in terror. Even with that massive, terrifying drop, major transactions are still clearing. Total sales volume for the quarter was 2.56 million square feet. People are out there actively catching the falling knife.
Because it's not a panic. It is a highly calculated reset to a new reality.
The specific sales in the report really illustrate this, I think. You have Namdar Realty Group buying the massive 1.04 million square foot 601 Jefferson Street building in the CBD.
Yeah, that was a huge deal.
But the one that really caught my eye was 1002 Noble Energy Way. It's a 470,000 square foot building, and it was bought by First Community Credit Union. They aren't a traditional real estate investor, you know. They are an owner/user.
And the owner-user strategy makes perfect sense in a heavily discounted market like this.
Because they need the space anyway.
Right. I mean, if you are a credit union looking at your 10-year operational costs, you just run the math. You can keep leasing space and subject yourself to the winds of the rental market and those rising Class A rents we talked about. Or you can buy a massive asset at $78 a foot, take complete control of your headquarters, put your name in giant letters on the side of the building, and lock in your overhead costs for a decade.
Wow, yeah. It's the corporate equivalent of deciding to buy a house because the housing market crashed instead of continuing to rent.
Exactly. It's a no-brainer if you have the capital.
But what about the investor side? How does an opportunistic buyer like Namdar make money buying a mostly empty skyscraper in this environment?
It all comes down to their cost basis. Because they bought the building on the clearance rack at $78 a foot, their monthly debt service, their mortgage, is a fraction of what the previous owner was paying.
Oh, I see. Since their monthly nut is so low, they suddenly have the cash flow to actually play the game.
They have immense flexibility now. They can afford to invest $50 a foot into building out that luxury gym and the espresso bar we talked about to elevate it to Class A. Or they can offer slightly lower rents to aggressively poach tenants from neighboring buildings and still turn a very healthy profit.
And the previous owner couldn't do that because their massive mortgage was choking them.
Exactly. The new buyer comes in completely unburdened.
But they are still taking a huge risk buying into an office market in the late 2020s. What gives them the confidence that those buildings will ever fill up again?
The broader Houston economy. You have to remember, real estate does not exist in a vacuum. And the macro tailwinds here are acting as a massive shock absorber for the city.
Yeah, the fundamentals in the report are incredibly solid. Total employment is humming along at 3.46 million jobs. The unemployment rate is 4.2%, which is actually lower than the broader U.S. average of 4.3% right now.
Right, the job market is strong. And you also have West Texas Intermediate crude oil sitting at $112.06, which provides massive stability to the heavy energy sector footprint in the city.
Energy is always the backbone there.
It is. And critically, inflation has cooled down to 2.4%, which gives corporations the predictability they actually need to feel confident signing a 10-year lease.
So you have this powerhouse local economy driven by energy, healthcare, and logistics that acts as a safety net against total collapse. Companies are absolutely still hiring, they're still doing business, they just demand a very different physical environment to do it in.
Precisely. So opportunistic capital steps in, they look at those strong economic fundamentals, they look at the 75% discount on the building, and they make a very calculated bet on the long-term survival of the city.
Wow. So bringing all these threads together for you listening, the narrative of the Q1 2026 Houston office market is actually surprisingly clear. It is a slow, choppy, really grueling path to recovery, entirely dictated by a flight to quality.
Yeah, quality is everything now.
If you own a premium, amenity-heavy building, you are defying gravity. Your rents are climbing, your spaces are leasing, and you are winning the war for talent.
Meanwhile, the total lack of new construction is the silent hero here. It's starving the market of new supply so the city can slowly digest its own empty space.
And the financial reset down to $78 a square foot is washing out the old, over-leveraged owner and bringing in fresh capital with the flexibility to actually compete. It's a ruthless ecosystem.
It is capitalism at its most raw.
It really is. But there is a massive lingering question here, and it's something I want everyone listening to ponder the next time you drive past a skyline.
Because this is truly the defining urban challenge of the next decade.
If developers are only ever going to build premium spaces from now on, and companies are only willing to pay for luxury Class A environments to retain their employees, what is the ultimate fate of the millions upon millions of square feet of standard, uncompetitive Class B office space?
That is the multi-billion-dollar question.
Are these massive concrete structures going to just slowly rot into urban ghost towns? Or are we on the verge of having to radically, fundamentally reimagine what a commercial building is even allowed to be?
I think we are going to find out very soon. The pressure is building.
And the answer to that will literally reshape the maps of our cities. Thank you for joining us on this deep dive into the real mechanics of the Houston market. Keep questioning the numbers, and we'll catch you next time.